Good afternoon, everybody. So today we will continue with variances, and today we'll talk about further variances analysis and operating statement, including the fixed overhead variances and the sales variances. Let's have a look. Okay. Right. So today we will cover what are the meaning of variances, what is the relationship between these variances, and also we need to prepare the operating statement which reconcile the budgeted profit with the actual profit through the variances. So if you remember last week we introduced the variance standard cost variance analysis, and we did mention the variance is the difference between the actual results and the budgeted results. If it's the results is good for the business in favor, that's called favorable. But if the results it's bad for the business, this means it's adverse or unfavorable. For example, if the actual cost is more than the budgeted cost, this means it's unfavorable, adverse for the business, and vice versa. It's favorable if the actual cost is less than the standard or the budgeted cost. As I mentioned, we did last week we covered material variances, including price variance and usage variance. We did labor variances, including labor rate variance and including labor efficiency variance. Also, we looked at the variable overhead, including the variable overhead spending variance and variable overhead efficiency variance. So today we will cover the fixed overhead variance, and also we will cover the sales variances. And after that, we will practice on an example which we need to prepare the operating statement. These are the reasons for variances which we covered last week. So including the material variance, if it's favorable or it's not favorable, adverse, what you could suggest some reasons. So again, for material usage variance, we covered it last week again. So if it's favorable or it's adverse, so what could be the possible solution, or not the possible solution, the possible suggestions for it. Again, in terms of labor rate variance, if it's favorable or it's adverse. And in terms of labor efficiency variance or variable overhead efficiency, again, what could be the reason for this? Again, this is some suggested answers. So all of these we covered last week. Now today we will jump to the fixed overhead variance. In terms of fixed overhead variance, we have two sub-variances under fixed overhead variances. So in your formulas, what we've done so far, we've done 6 formulas for variances, including material 2 variances, variable labor 2 variances, and variable overhead 2 variances. So far 6 variances. Today we will study 4 other variances. So at the end of the lecture, you should be able to have 10 variances in the front of you, so you can use them when it comes to prepare the operating statement. Right, let's have a look. Now, when it comes to fixed overhead variance, we have 2 sub-variances, including the expenditure variance and the volume variance. Fixed overhead expenditure is the difference between the actual expenditure and the budgeted expenditure. But in terms of volume variance, in terms of fixed overhead volume variance, is the difference between the actual production from the budgeted production. So the 2 formulas which you really need to write it down. Okay. So heading fixed overhead variances. So underline, and then you start with the first variance under fixed overhead is the fixed overhead expenditure variance, right? And this is the formula which you need to write down here, which is the budgeted fixed overhead minus actual fixed overhead. So this is the formula, you need to write it down. In terms of the second variance under fixed overhead variance is the fixed overhead volume variance, and the formula, as you see, the actual production units minus budgeted production units times the OAR, which stands for overhead absorption rate. Okay, so far, again, please write them down so we will use them in a bit. In terms of sales variance, again, we have two formulas for sales variance. We have the sales price variance and the sales volume variance. Okay, and when it comes to sales variance, as you mentioned, it's the difference between the planned sales and the actual sales. And again, this is in terms of price and in terms of volume. Okay, let's have a look. So the two formulas which you need to list them here. The first one is the selling price variance, and the selling price variance equal the actual selling price minus budgeted selling price, and then you multiply by the actual sales in units. The second formula, which you need to write it down under your formula sheet, is the sales volume variance, and the sales volume variance including the actual sales units minus budgeted sales units, and this you multiply by the standard profit margin, So far, guys, we have two formulas for sales and two formulas fixed overhead. So you need to include them under the formula sheet. So far we should have 10 formulas. So in terms of the reasons for the fixed overhead expenditure, this means we spend more fixed overhead. That could be, if we spend more, this is adverse, isn't it? So this could be any reason, such as increase in cost services, could be excessive in use of service, could be anything in terms of overhead, because the overhead is other type of cost other than material and labor. For example, we hire more supervisors, we increase marketing, rent is more maybe. So look, could be anything. However, when the fixed overhead expenditure is less, the actual is less than expected, that's lead to favorable one, and could be anything in terms of saving and in terms of more economical use of service, so more being efficient in a way. Okay, in terms of fixed overhead volume, when I talk about fixed overhead volume, means the actual production units is more than the plan, the expected one. This is favorable, it's great, good, well done, being efficient. However, if the actual production less than the budgeted production, this means is adverse for the business, because this is what they plan for specific units, but having to be less. So this comes to be adverse for the business. In terms of sales variance, we have sales price variance. Sales price variance, if it's favorable, it's great. This means that the selling price is more than the actual selling price, is more than the budgeted selling price. And this is great. This is good results, isn't it? So what could be the reason? Could be many reasons, such as, for example, there is a demand on it, there is no really specific competitor, or the competitor is not really as we expected when we set up a price. So it could be anything really positive, or maybe the customer loved this product and they have really customer loyalty for this product, and as a result we could really set a higher price. In terms of if it was unfavorable or adverse, the sales price, this means the actual selling price is less than the budgeted selling price. Again, could be any reason, such as competition is high, for instance. Could be the cost of product is more, maybe the cost of the unit is more, not as we expected, could be many reasons. In terms of sales volume could be favorable. What does that mean? This means that we sold units more than we budgeted, we expected, right? Again, when it comes to this, if we sold more as an actual, this means there is a demand on it, maybe there's a great marketing campaign, we offer discounts, could be many things. Unexpected change customer needs, maybe Christmas time, maybe events. In terms of sales volume, if it's unfavorable or adverse, this means the actual sales units is less than the budgeted sales units. And again, could be many things happening. For example, pandemic, for instance, economic recession, for instance, weather doesn't help. Could be many reasons which really can lead to sales volume to be adverse. Right, now let's come to the operating statements. So now what we need to do, we need to prepare an operating statement, and this operating statement, it does reconcile the budgeted profit with the actual profit using what? Using the combination of all variances. So when it comes to variances, we need to look at sales variance, the budget profit, and all the cost variances, including material, labor, and variable overhead, and also the fixed overhead. Right, okay. Let's now jump to lecture example 1. Okay, so this is lecture example 1. This is what we will cover today, so you can understand how to prepare the operating statement. So for this company, as you see, this information is related to the budgeted figures, including we have two materials, Q and R. And the budgeted is, as you see, for Q, we need 4 kilogram at 2.5 per kilo. That's equal 10 pound. For material R, we have 5 kilogram at 6.20, 31. That's all budgeted. We have direct labor, the budgeted 3 hours times 6 pound per hour, 18. Variable overhead 3 hours because it's related to labor, times 4 pound per hour equal 12. Fixed overhead per unit equal 20. So if you these all the cost per unit, the budgeted cost per unit, and the budgeted selling price per unit is 114 pound. In terms of the volume, is 1,250 units. It's the budgeted sales and production volume. There is no difference between sales units and production units, so it's equal. In this case, we would expect that 1,250 units is the actual, the budgeted sales units, and also the budgeted production units. These all the budgeted figures. In terms of the actual figures, what we have here, we have in terms of the sales, here we go, we have 1,100 units, the actual sales units, and also the actual production units. Why? Because we say it's what it is equal, isn't it? That's the total, 129,800. So of course, in order to find the actual selling price per unit, what you need to do, you need to divide 129,800 times over 1,100 units. In terms of material Q, it does tell you the actual quantity involved, all 5,350, and the total cost for material Q is 12,910. Again, in this question, it does give you 2.5 per kilo. So if you divide it, let me just divide it just quickly, 12,000 910 divided by 5,350. That's almost 2.42. Okay. Okay. Why it's not working? Okay. 2.42. Okay. I'm not sure why it's missing here. Let me just, or maybe I write it down here. 2 point. Anyway, you write it down. 2.42. Yeah. 2.42. Let me try write it down here. See if it works. Yeah. Here we go. Here it works. Yeah. That's 2.42. Almost. Yeah. So 2.42 per kilo, 2.42 per kilo. That's almost, yeah. But when you take it, so do not use exactly 2.42. You need to use exactly the same decimals on the calculator. Exactly all the decimals on the calculator to have the right answer. Okay. So as you see, it's 2.50, 2.42 is almost close to each other. Yeah. So remember one trick you could really think about. So when it comes to variances, must equal in some extent. Not equal. Not sorry. Not it has to be close to each other. I mean, if this number, if the actual material for a Q happen to be, for example, 40 pound or 50 pound, then you need to question, oh, there's something wrong, isn't it? So you can't compare 50 pound actual quantity per kilo with the 2.50 per kilo. I'm sure there is something wrong, isn't it? So you need to question yourself. So again, I'm not saying that has to be close, but in some extent, logic behind. In terms of sales per unit, so if we did 129,800 divided by 1,100 units, that's 118 pound exactly. So 118 pound exactly. So this is the actual selling price per unit. Okay. In terms of material, compare with what? Compare with 114. In terms of material R, the total material R, the kilogram equals 6,370 kilogram, and the total cost is 38,857. So that's A 38,857 divided by 6,370 kilogram. So that comes with 6.1 per kilo. Okay. 6.1 per kilo. Okay, good. In terms of direct wages or labor, so as you see here, we have £6 per labor, the budgeted labor per hour. Here we have 4,100 hours worked. The actual and the total labor cost equal 24,010. So that's a 24,010 divided by 4,100 equal almost, not 100%, 86. Okay, 5.86. So 5.86 compared with what? Compare with £4. Compare with £4. Sorry, £6, isn't it? Yeah, £6. Okay. In terms of variable overhead, so we have the total cost, the actual total cost for variable overhead is £15,580. So again, as you see in the question, there is no hours for labor. So how can I find out what is the variable overhead per unit? How can I know this? So here £4 the budgeted. So how can I do this? So basically in this case, as I mentioned in the lecture, we need to rely on number of labor hours. So we absorb the variable overhead based on number of labor hours. So what we need to do, we need to look at the number of labor hours, which is 4,100 labor hours, the actual. So that's 15,580 pound. 15,580 pound divided by 4,100, that's equal 3.8. 3.8. So that's £4 compared with £4 the budgeted. Okay. In terms of fixed overhead is 24,000. Of course, fixed overhead is fixed overhead. So regardless of number of production change is 24,000 the actual fixed overhead. Okay, dokie, that sounds perfect so far. Excellent. Right. So now it comes to the first part of the question. The question asks you to calculate the budgeted and the actual profit. So how can we do this? Okay, dokie, let's do it, guys. So the total budgeted profit, which is, look here, we have here all the cost plus we have the selling price per unit. So what you need to do, so £114, this is the budgeted selling price. You need to minus all the budgeted cost. So in order to find something called the standard profit margin or the budgeted profit margin. Look here. So the total cost equal £91, right? And the budgeted selling price equal £114. So £114 minus £90, it does give you £23. £23. So £23 is called the standard profit margin or the budgeted profit margin. So write it down, standard profit margin or the budgeted profit margin. And this you need to multiply by what? In order to find the total budgeted profit, you need to multiply it, of course, by the number of what? By the number of units, which is, if you look at the question, it's 1,250 units, isn't it? 1,250 units. So if you multiply, you should be able to find that budget profit is £28,750. In terms of the actual profit, is much easier. Why it's much easier? Because in the question it does give you the figures straight away. So what you need to do really, so sales, that's the total sales. You need to minus, subtract all these costs involved, including 12,910, 38, right? These all the costs are involved, and then you need to subtract them from the sales, the total sales, which is £129,800. If you deduct them, you should be able to find that the actual profit is 14,443. And again, this is the way. So as you see, the budgeted profit, our budgeted profit is what? Is it £28,750. However, our actual profit happened to be what? Only 14,443. As you see, there is a difference, isn't it? There is a difference. And this difference is due to variances. Is it due to variances, including material, labor, variable overhead, fixed overhead, and also sales variances. So now, in section B of the question, what we need to do in section B, we need to look at and find out the variances. So we need to calculate the variances for each of the items listed above and prepare the statement, the operating statement, which really can reconcile the budgeted and the actual profits calculated in this part, right? So let's have a look in this case. Let's have a look. So we need to start first of all with the sales variance. So there are two ways to do the variances. Could be through the formulas here, as I taught you, or could be another way to do it. So it's up to you which way. Both of them are available. So it's up to you. I'm covering the formulas. So according to the sales variances, the first, we need to start with the first variances, sales variances. So sales variances is divided into selling price variance and the sales volume variance. Okay? And what we need to do, we really need to do just to follow the formula, which is, if you remember, the formula for selling price variance equal the, if you remember, equal what? Equal 118 pound, which is 118 pound, which is what, if you remember, if you go back to the question, you will see that the 118 pound is, I guess, the actual, isn't it? Let's have a look. Yeah, here we go. The actual selling price, yeah? Here we go. So the actual selling price minus the actual selling price minus the budgeted selling price, which is 114 pound, then you divide it by what? You divide it by the actual sales units. The actual sales units, right? So again, the budgeted, the actual selling price per unit, 118 pound, minus the budgeted selling price per unit, 114 pound, and you multiply by the actual sales units, which is actual sales units equal 1,100 units. So if you apply this, you should be able to find the answer is 4,400 pound. Favorable. Why it's favorable? Because as you see, the actual selling price per unit is more than the budgeted selling price per unit. So that's normal to be what? To be favorable. If you are not sure about favorable or adverse, so I wrote the formulas. It try to help you to know if it's favorable or adverse in terms of the positive or negative number. If it happens to be positive number, so likely to be favorable, and negative number likely to be adverse. So I set up the formula based on this. In terms of the second variance for sales variance is the sales variance or sales volume variance, which is the actual sales units minus budgeted sales units. So actual sales units, which is in the question, right, 1,110 minus the budgeted sales units, 1,250 units, isn't it? So that's fine. And then you multiply by what? You multiply it according to the formula. You multiply by the standard profit margin. Standard profit margin. And the standard profit margin is 23 pound. If you remember, this figure comes from here. Did you remember when we calculated the budgeted profit? So that's selling price, budget selling price per unit minus the 91 pound, which is the total cost per unit, budget cost per unit, equal 23 pound, which is what? Which is the standard or the budget profit per unit. This is 23 pound you included here. Right, if you do it, you should be able to find the answer is what? Is 3,450 pound adverse. Why it's adverse? Very simple, because as you see here, so the actual unit sales is less than the budgeted sales in units. So basically that's why we have adverse here. Okay, that's all to do with sales variance. Now let's move to material Q. In terms of material Q, okay, as I mentioned, material is divided into two variances, which is the price variance and the usage variance. In terms of the price variance, again, if you remember the formula, which is a standard price minus actual price divided by actual quantity. Okay. If you look at the material Q, you will see the standard price is 2.50 here. This is a standard look. that's the standard price per kilo, minus the actual price for per kilo for Q is 2.42, isn't it? 2.42. Let's have a look. Yeah, can you see 2.41 or 2.42? As I mentioned, this is only estimation. You need to leave all the decimals on the calculator. You need to multiply by what? By the actual quantity for Q. And if you look at Q, you will see that the actual quantity is what? Is 5,350 kilogram. And here we go. Yeah. So the answer is 465 pounds. It's favorable. Why it's favorable? Very simple. Because the actual price really per kilo is less than the standard price per kilo, and that's why we have favorable. In terms of usage, material usage variance, the formula is standard quantity minus actual quantity multiplied by standard price. Okay, let's have a look. Standard quantity. How to calculate a standard quantity? I explained to you how to do it. Let me again show you how to do it. Standard quantity for Q, look here. The required per kilo, the required 4 kilogram per unit, isn't it? For material Q, the required 4 kilogram. This one, in order to calculate the budgeted or standard quantity, you need to multiply by the actual output, or the actual units, which is the 1,100 units. If you multiply it, you should be able to find the answers there, which is, where is it? 4,400. 4,400 kilo. Minus the actual quantity. The actual quantity for material Q is 5,350, and multiply standard price, which is the 2.50. You should be able to find the answer is 2,375. Is adverse, of course. Why it's adverse? As you see, because the actual quantity, where is it? Yeah, here we go. The actual quantity is more than the standard quantity, so we use more materials than we expected, and that's why we have adverse material usage variance. In terms of material R, it's absolutely the same as material Q, absolutely the same. So what you need to do, really, you just really need to follow the same steps when it comes to material R, the same as we've done for material Q. There's no difference at all. So try, guys, please try it and come back and see the answers for material R. Okay, now let's come to labor variance. Okie dokie. Now for labor variance, we have again we have two variances in terms of labor rate variance and in terms of labor efficiency variance. In terms of labor rate variance, the formula is standard rate minus actual rate times standard rate minus actual hours. Okay, right, as you see, it's the same formula as the material price, but instead of P, R, and instead of Q, H. So if you apply, so you will see that the standard rate is £6. Why £6? Let's have a look. Yeah, can you see it's £6 is the standard rate per labor hour. As you see, £6 minus the actual rate for labor. As you see here, we did it, is almost 5.86. Yeah, as you see, 5.8 or 80. As I mentioned, it's estimation. You need to keep all the decimals on the calculator. and then you multiply by the actual hours, which is 4,100. As I see, it's the actual hours here, which is the 4,100 hours. So if you apply the formula, you should be able to find that's £590, which is what? Which is favorable. Very simple. Why it's favorable? As you see here, the actual rate is less than the standard rate. So we pay labor rate less than we expected, and that's why we have favorable variance. In terms of efficiency variance, we have the formula, which is standard hours minus actual hours times standard rate. Okay. Again, how we can calculate the standard hours is the same way we calculate the standard quantity. Yeah. So standard hours, if you look here, you will see that. Okay. Have a look. Yeah. You will see the required time is 3 hours. The required time 3 hours, and this you need to multiply it by what? You multiply it by the actual output or the actual units, and the actual output or the units, as you see, is 1,100 units. So here we go. That's 3,300 hours minus the actual hours, which is 4,100 hours, and multiply the standard rate for £6. So you should be able to find the answer is 4,800. Adverse. Why it's adverse? As you see, the actual hours, labor hours, is more than the budgeted hours, and that's why we have 4,800 adverse. Okay, dokie. In terms of variable overhead, the variable overhead is we absorb it based on number of labor hours. So basically, we are using the same formulas exactly. So in terms of spending, variable overhead spending, we use the same formulas for labor rate, and in terms of variable overhead volume or efficiency, we use, oh no, where's that? Oops, this one, yeah. We use the same formula for efficiency, labor efficiency. Okay, so as you see here, we have the spending, which is a standard rate minus actual rate times actual hours. Let's have a look. So now the standard rate for variable overhead, look here, look, what's the standard rate here? As you see, it's £4, isn't it? Standard rate is £4. The actual rate for variable overhead is what? Is £3.80. Look, £3.80. Okay, and then you might multiply by the actual hours, and as I mentioned, the actual hours based on the labor hours, which is the actual labor hours, which is 4,100. So here we go. Yeah, so you should be able to find the answer of what? Of £820 favorable. Very simple. Why? Because the actual rate is less than the budgeted rate. In terms of efficiency, in terms of standard hours, is the same, 3,300 hours, as the same as labor efficiency, because if you look at the question, it is 3 hours, the same, and you need to multiply it by what? By the actual output, actual units, 1,100 units. And here we go. Actual hours for labor, 4,100, and multiply standard rate for variable overhead, £6. So the answer is 4,800 adverse. And that's for labor variance. No, wait, what is that? no, variable overhead, sorry, £4. That's 3,300, which is similar to this, that's right. And minus 4,100, that's right, similar to this, but we need to change what? The efficiency, which is the £4, the standard rate for variable overhead. So the answer is 3,200. Again, is adverse. Why? Because we use more labor hours than budgeted. And the last variance we will look at is the fixed overhead variance. And in terms of fixed overhead variance, we have two formulas again, the expenditure variance and the volume variance. In terms of the expenditure variance, the formula which you need to follow, budgeted or fixed overhead minus actual fixed overhead. Okay, here we go. Let's have a look. In terms of budget fixed overhead, is it £25,000? Look at the question. Why £25,000? Look, where is the question? Here we go. Budgeted fixed overhead, total budgeted fixed overhead. Look at budget fixed overhead per unit is £20. So if you multiply this by the budgeted units, budget production units is 1,250 units. So let me multiply 20 times 1,250 equal to £25,000. So this is the budgeted fixed overhead, £25,000 minus what? Minus the actual fixed overhead, which is £24,000. So as you see, this is £1,000. It's favorable. It's favorable. Okay, very simple. Why? Because as you see, the actual spending was less than the budgeted spending. In terms of the volume, the last one, the fixed overhead volume variance. So the formula which you need to follow is the actual production units in units minus budgeted production units, okay, times OR, isn't it? Yeah, that's right. Here we go. Yeah, that's right. Cool. Actual production units equal, let's have a look at the question. Actual production units equal, as you see, is 1,100 units minus 1,250 units, as you see, look. Yeah. And then you multiply by OAR. OAR stands for budgeted, overhead absorption rate. Overhead absorption rate means the budget fixed overhead per unit. So the budgeted fixed overhead per unit in the question is a £20. That's same terms as OAR. So the answer is 3,000 adverse. So why it's adverse? Very simple. As you see, it's the actual production units is less than the budgeted units, is less than the actual units. So as you see, the actual production units 1,250 units, but it's less than the budgeted units of 1,100 units. So that's why we have adverse £3,000. So as you see, we have 10 formulas here, which we've done it, 10 formulas. These for 10 variances. And what's really next job? To prepare the operating statement. And when it comes to operating statements, it's really simple, straightforward, really. Is not really big deal for this. So what you need to do in operating statement, you just need to copy paste the numbers here. So you need to list the favorable under favorable column and the adverse under the adverse column. So you start with the budgeted profit of a £28,750, and then you reconcile them to reach to £14,443. Let's have a look. Here we go. So as I mentioned, you start with the budgeted profit, which is £28,750, and then you need to do the reconciliation in order to reach to the actual profit of £40,443. So the first variance you need to start with is the sales variance, and then you move to the all cost variances there. In terms of the sales variance, we have a price variance for 400 favorable, 450 the volume variance adverse. So it's 900 net adverse for sales. Why? Because 400 minus 3,450 equal £950. And as you mentioned, so you need to treat favorable F as a positive number and A adverse as a negative number. So that's the £28,750. If you add up the £950, you should be able to find that the total is £29,700. Okay. Then you need to list all the cost, including materials, labor, variable overhead, and fixed overhead. And you just list them under which one goes favorable and which one goes adverse. At the end of the day, so the total favorable for the cost this, and the total adverse this. So the net is this. So £15,257, right? So what you need to do, £29,700. So you need to minus the net variances, cost variance, so equal £4,443. And as you see, it does really reconcile between the budget profit and the actual profit, and this is due to variances involved. Yeah, that's all to do with operating statement, right? I hope it's clear. So the key, I think the key is to practice, and the key is to memorize the formulas. So my opinion to you, my advice to you, and my opinion, so these formulas, write it down on a piece of paper, 10 formulas, and so you can access them easily. So don't get confused. So all of these, the formulas are available in front of you, and you can apply the formulas and do the variances, and then do the operating statement. Okay, so basically the last thing, this statement is done using the absorption costing method. So in operating statement, we have we can prepare two methods using absorption costing and using variable costing. This is done using absorption costing. So of course, when it comes to variable costing, is almost 95% similar, in just one small differences, which you can see in the seminars. We'll explain it in the seminar. Okay, dokie. So now, okay, that's we finished this. So as you see from the questions we've done here, as you see, we started with profit variance. So we need to reconcile it, including, as I mentioned, first of all, we've done the sales variance, including the two variances for sales, including sales price variance and sales volume variance. In terms of the cost variance, we have the material cost variance, labor cost variance, variable overhead variance, and the fixed overhead expenditure and fixed overhead volume variance, and all under two formulas under each, as you see. So this is what exactly we've done under the operating statement. Right, the last thing, it's we done it many times in last week lecture. So what is the impact and the investigation on variances? As I mentioned, is not all the time is worth investigating in the variances. So sometimes could be not worth it really. So if it comes to be a small number really, so what's the point if really small number and we investigate in variances? Is not really the point. So we need to look at some factors. Could be, for example, if the price is materialistic, the difference. If the variance is materialistic, materialistic mean that it does impact on the profit, it does impact on the cost, it does impact on operations on the business if there's a materialistic. But think about it, if there is a variance of £10 or £20 or £30, is that worth investigating? Not really, because we need to look at the cost benefit relationship. So is it worth to investigate in this? Is it the cost exceed the benefits or the benefits exceed the cost? So again, that's really also another fact we need to look. And also we need to look at in terms of the cause of variances. What really caused the variances? Maybe the cause is clear. Maybe there is a really unforeseen circumstances and the reason is clear. Why do we need to investigate? Or maybe we need to look at also in terms of the interrelationship between all the variances, because one variance might affect on the other variances. Yeah, that's all from me, guys. So this is the end of the lecture. Thank you very much. Have a lovely day. God bless.